And again, that tells you that you're getting a lot more buying pressure and that the potential direction is to the upside. Let's get ready to rumble. What's up, guys? It's Mr. Fit to Flourish. Welcome to the Fit to Flourish podcast. Today, I'm going to be talking about chart patterns. Well, I was going to be talking about chart patterns, but I wanted to talk a lot about bar sizes and reading candlestick charts in depth. So we're going to go a little bit more in depth on reading candlestick charts, and then we're going to get into chart patterns. And I thought that this is the only way that makes sense. So let's talk about some ideas that a lot of online traders really don't talk about, but you need to know this in order to begin trading. Let's get right into it. When it comes to trading, there are basically three types of bars. So there are dojis, which are trading sessions where the open and the close price are the same or small in difference. Therefore, your body is pretty small. And then you have these long wicks at the top and at the bottom, or at the top or at the bottom. And then you also have trend and non-trend bars. So a trend bar is going to look like this. They're pretty big bars that show that there's either a lot of buying or selling. In this case here, we see that there's a lot of buying because these are big green bars, okay? So trend bars look like this, where they're really big. And then you have non-trend bars, which are really small bars, and they don't contribute to the direction of the trend. So they're really small bars. So here you can see very little buying. And then if it's red, it's very little selling. Here you can see you have a trend bar, so there's a lot of buying pressure, a lot of buying. So that's basically the main topic I wanted to get out of the way before we get into the main topic of chart patterns. That's something you really need to understand, is the size of the bar definitely contributes to how you're going to want to trade. If it's a bigger bar, then it tells you that there's a lot of movement in that direction. So if it's green, it's going to be moving up. And if it's red, it's going to be moving down. And then if it's a small bar, you don't really want to be trading there because you don't know what direction it's going to go in. You don't know what direction price is going to go. It's just going to pretty much be going sideways, which is called consolidation, and that's something we'll talk about later on. So let's get into some of these patterns. So some of the patterns that you're going to need to know that you'll see quite a bit are going to be the head and shoulders pattern. So the head and shoulders pattern, basically the inverse head and shoulders is very bullish, while the head and shoulders is very bearish. And some of these other patterns are other patterns that you might want to take a look at and just kind of memorize. The cup and handle formation typically looks like a cup. And the rule for this one is that the target after the completion of the cup and handle is going to be the length of the cup depth. So usually you can measure out the depth of the cup. And then once you add that to the handle, that's the expected move that you're going to get after that formation. So a cup and handle formation occurring is ultimately bullish, and it can be upside down, and that would make it bearish. After the formation is completed, you can set a target trade that extends as far out as the depth of the cup. So you measure from the bottom of the handle upward for your target profit. Now I'm going to be showing you some patterns that indicate that there's a lot of buying pressure or that you might want to buy. So at the end of a downtrend, you might see an inverse hammer. So an inverse hammer is basically this candlestick formation where you have a large wick at the top, showing that you have buying pressure after this dramatic sell-off. Typically, this indicates that a potential direction is shifting to the upside, also known as buying pressure. Another major one that you'll see quite a bit is that after a downtrend or consolidation, you'll see that there's something called a bullish engulfing candle, which is showing you that a big green bar is eating up a little red bar. And again, that tells you that you're getting a lot more buying pressure and that the potential direction is to the upside. And then there's a piercing line bar. It's basically showing you that if you get more than halfway above a previous downward movement bar, then you're going to see that price will potentially continue to move to that upside. And then a morning star is after a downtrend, you get this really small doji. It's a morning star doji is what it's called. And it's telling you that selling pressure is going away because you're not getting these big red bars pushing down anymore. Now you're getting smaller red bars, which means your sellers are probably going away and you're getting buyers stepping in, which is pushing price up. And then three white soldiers is very bullish, and that's where you have like these three big green bars. Now we're getting into some of the bearish signals. So the first one being the hanging man doji. So after an uptrend, you'll see something like this, which looks like an inverse hammer, but it's actually a hammer doji. And basically it's showing you that we're losing buyers. So it indicates that bulls are losing control of the market. And therefore your potential direction is to the downside. And then you have an inverse hammer at the top, which is a shooting star doji. And this means that your buying pressure is going away. So whenever you see a wick at the top When you're in an uptrend, you see wicks at the top. That's telling you that sellers are stepping in and pushing price down. Sellers are stepping in and pushing price down. So wicks at the top mean that sellers are pushing price down. And then you have a bearish engulfing bar where the red bar is eating up the little green bar. Just like the morning star doji, you have an evening star doji. So at the top of an uptrend, you get a smaller bar here. It's a doji. And remember, dojis are where the wicks are larger than the actual size of the body of the candle. So the evening star doji is basically showing you that the potential direction is going down and that your buyers are probably going away because you're not getting these big green buy signals like before. And then three black crows is just like your bullish bars, your three white soldiers, but instead this is going to the downside. And then again, we talked about dojis a little bit earlier, and dojis signify a close and open price that are similar or very small in difference. Therefore, you get these massive wicks up top and bottom, or at the bottom or at the top. Hammer dojis look like hammers. And then this is just a typical doji here on the side. So memorize these patterns like your life depended on it, because these dojis, big bull bars, bear bars, etc., they'll tell you a story of what's coming next on the chart. If you have any questions, drop them in the comments. Thanks for tuning in to the Fit to Flourish podcast. I'm out. Peace. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance,